We have just one more panel for you. And I think it's a really good panel to follow on from what we've just heard about, because the next panel we're going to talk and dig a little bit deeper at that commercial bank money and really thinking specifically about cross-border and why that's important. And the reason I'm coming back to it is we started off this afternoon talking about the wider use cases and the applicability for enterprises. And some of those use cases lie in very much in this taking the opportunity to make the cross-border payments far more efficient and both in terms of time but also in terms of cost. This is meaningful, and it's meaningful for a very large number of our clients that work in a global setting and in a global environment. The panel is going to be led now by Muneeb Saar. Muneeb heads up our digital asset technology consultant in the UK and has a tremendous amount of experience in this particular area. So I can't think of a better person to introduce the topic for you and our panel this afternoon. And I say over to you, Muneeb.
Thank you so much, Claire. And good afternoon, everyone, and thank you for joining us for the last panel discussion of the day. But as you say, we save the last and best for the last, right? It's almost that. Now, before I start, and obviously the topic for us for discussion today is exploring the role of cross-border payments and how that role is broadly changing. And I have an esteemed panel with me today, and we have one more panelist joining us online. So I'll let the panelists introduce themselves first, just briefly before we get into the weeds of the discussion. So Jana.
Thank you, Muneeb. Good afternoon. I'm Jana McIntosh. I'm a Managing Director at UK Finance, and I have a particular focus on payments and innovation.
Thank you. I'm Martin Hargreaves. I'm Chief Product Officer at Quant, and UK-based fintech, also on the technology side of things.
Hi, I'm Sophia Lopez. I'm a founder and a president of Kaleido Web3 Infrastructure Company.
And Bernard.
Right, I'm Bernard Schweitzer, joining remotely from Wall of Germany, head of SAP Digital Currency Hub, and we basically connect the enterprise world with the blockchain world. So honored to be there.
Fantastic. Thank you all for joining us. The role of cross-border payments is changing. We all know that. But the key question is change really needed, and why is it needed? Right? We all know cross-border payments remain slow, to a certain extent complex, to a certain extent costly. But how much of this is really due to outdated banking infrastructures and legacy infrastructures, and also in terms of the impact that from a regulatory perspective is more prevalent in terms of cross-border payments not changing at pace as we would want them to. So Jana, let me pose this question to you. So where is the line being drawn between legacy banking infrastructures versus the regulatory framework?
Thanks, Muneeb. It was really good yesterday, kind of listening to the conversation that kind of Paul Brody and kind of Peter Carstens were having. And I think Peter was saying we really need to understand the problems so that we can kind of design the right solutions. Because if we start with the solution, we're just going to create more problems. And I think this is kind of like one of those that kind of brings that to life. There are normally a couple of things to think about. There's the technology and infrastructure question. Because we do know that there's legacy systems, but if we think just replacing all the legacy systems will solve the problem, that is not true. There are other buckets of activities and kind of and issues that we need to work through as well. The other two big ones is the business case and the kind of business analysis around the change and what that means. We do need to understand kind of like what that means for business models, what that means for customer journeys, what that means for products that people want to build on the back of kind of like these cross-border changes. And then there's the legal and regulatory bucket. So you're right, that also kind of comes into play, where you need to think about kind of like how there are jurisdictional changes between these, the rules and the different standards that would apply to kind of different systems and different jurisdictions to kind of like help move the kind of like transactions to where they need to go. And all of that contributes to the complexity and the cost. So it's not just one thing. You do need to kind of like try and analyze all of the different kind of facets of that to kind of understand what really causes the problem that you're trying to kind of look at and what the solution is.
I think that's a great point, Jana, and you rightly put it in the sense that it's not one or the other. It's quite a mixture of things that needs to come together to be able to solve it. But the interesting point is that we have often been hearing this, that digital assets and blockchain can really change the way cross-border remittances are done. And obviously there are quite a few experiments being done in this space, some pilots being executed. Also the fact that this has been going on for a while now, right? But if you think about these core inefficiencies that Jana just mentioned, right? So what is it that specifically the blockchain or the digital assets world can bring to life in terms of solving some of the key inefficiencies in payments? And let me start with you, Martin, right? So you being close to the payments narrative. So what's your view on that?
I would certainly echo what Jana said in terms of the tech. The tech is not 100% of the solution. It's probably not even 30% of the solution. So the incentives and economics behind it drive a lot of this. In terms of what I see as different, into the stablecoin world is now moving bearer tokens across what is effectively global databases. So that's fast, but also changes the compliance posture of everyone involved. Right? So stablecoin versus a registered instrument is very different. So I think that has it's proved well to work well in a consumer crypto kind of world. So people using it for remittances, it's been very popular, even down to when people are kind of sending Bitcoin through on and off ramps and using that for cross-border. So that on the consumer remittance has worked well for the folks that are comfortable with it, with some setbacks, some scams, those kinds of things. Scaling that up, I think the technology is there, but it's relatively hard for players and consumers to understand what's happening from a compliance point of view. Right. So yeah, it's wrapping everything else around that technology, I think, is going to be important.
Right. So I think if we go with the points that you made, Martin, so your perspective is that technology exists and it's relatively mature. Yeah. But at the same time, we now need to understand the implication of that and where it applies and how does it fit within the risk and compliance framework.
Absolutely.
Sophia, you're very close to the technology side of things, right, from a
Sure.
standpoint, and you're also working in some of the leading digital currencies projects, as we know. Interested to hear your perspective, right? So what role is technology really playing? And could we think of changing the face of cross-border remittances completely agnostic to technology, or does DLT really bring to life something, which is its USP, cannot be done in existing ways of doing it?
Sure. Yeah, I had a good chance to reflect during Paul Brody's opening talk yesterday. So he said he's been in the space for 10 years. And now we're into the sunshine, and there's been a lot of advancements. I think we've been through multiple generations of the tech. But one reflection is that, cross-border payments from day one, like 10 years ago, was immediately one of the use cases. There was a lot of energy in the industry around, and more broadly, even as part of global trade finance, programmability of those payments. So it's one very important piece that there had been a lot of major initiatives around. We've been part of many of those over the years. So I think the promise still holds, the better, faster, cheaper. It's sort of hard to put a percentage of how much the technology contributes to achieving that potential. I started 10 years ago as well, similar to Paul on the IBM side of things, and then I know he came over to EY 10 years ago. I had helped launch the IBM blockchain platform, and it was clear from those first 2 years of working with these early projects. And we even had WorldWire, which was one of the solutions looking at cross-border payments as well back then, that you really need a plug-and-play type solution where now technology is not the main goal of what you're doing. It's not a science experiment. It's not about getting plumbing up. And I think actually Paul had a great op-ed piece in CoinDesk today where he said engineers always like to build, but when you look at the adoption journey, it's really at a point where the technologies are mature enough, they shouldn't, you can do the partnering, the buying for that core enabling infrastructure. And now you get to where Jana, is where she's looking at like business models, regulations, all the other problems that we need to solve. But as Martin is saying, there's some people already, with stable coins. I think there was a report last summer. It's less than 1% of the cross-border sort of payments today, but it's very exciting. There's some people who are making a lot of money in the stablecoin space. So you see financial institutions looking at that and saying, if I could be as profitable, with the stablecoin as a Goldman Sachs, in 2024, maybe stablecoins are worth looking into too. So there's a lot of dynamic sort of interest in the industry right now, and reapproaching this problem that's people have been looking to solve for a decade now.
Perfect. And I think broadly, if you think about these emerging technologies, emerging asset classes are sort of rewiring the traditional way of doing cross-border remittances. But Bernard, let me put this question to you. Obviously, you are close from SAP standpoint in terms of working with banks from a core banking standpoint, working with treasuries. If you think about the core role of blockchain and digital assets broadly, it's 24/7, 365 days a year, sort of a real-time settlement applicability that it brings to the table. But how does this challenge the traditional liquidity and treasury management models? Right. So, have you seen that impact sort of evolve when you are in discussions with your clients? What is their view on that from a treasury perspective?
I mean, Treasury really cares about all the benefits that have been alluded to before. So it's basically lifting efficiencies, being cheaper, being faster, being also available outside banking hours. So I was talking to one client, actually financing leases, for instance, and they said, our counterparty would want to have the money at the last day of the month, midnight. And closing times of the bank is 6 o'clock. So how should I do that? So I think the notion of always on 24/7 is kind of solving a real problem. Probably not for 99% of the cases, probably more for the niches, but I think there is a problem. Now, the tech is there. I think we discussed that already. I think compliance is slowly but surely emerging, not only in Europe, but at a global scale. I think we can tick all those things. What we hear from our clients today is the integration that is missing. So I can do a stablecoin payment, I can do it on blockchain, but I cannot reconcile my ERP system today. And I think this is exactly what we need to solve as an industry, and this is the contribution that SAP is going to make with this digital currency hub, basically building the bridge between a core enterprise system on the one end and a blockchain on the other end. And by that, really kind of having a seamless process, so you do not need to change your payment factory. You book your invoice just as any other invoice. You just flag that invoice to be paid via stablecoin, and then everything, all the magic happens behind the scenes, including a fully automatic reconciliation. Right. And that, I think, puts the missing link between the basic tech being there, the compliance being there, now on a level that really makes the enterprise great.
Perfect. No, I think, and if we broadly think about it, right, so we, based on the initial discussion, right, it's very evident that we are thinking that cross-border remittances would evolve with digital assets and digital currencies. But the reality also is that there are too many asset classes out there, right? So we're talking about stable coins, we're talking about tokenized commercial bank money, and we're talking about CBDCs. So Jana, which one of these, is the predominant one? So do you think these are more sort of interoperable, or is there one which will be the horse running the longer race?
That's a good question. I mean, if you think about the evolution of payments, we are quite well used to different types of payment methods existing alongside each other. We have that today in many different ways. But when you think about kind of like all the new ones kind of coming in and the evolution thereof, in the beginning it's inevitable that they will fit alongside each other. They will be complementary in some ways, or they'll provide a consumer choice and kind of like enable kind of competition. And then over time, depending on the best application, the best business case, the best kind of consumer benefits that realize over time, one of them may very well kind of like end up being more prevalent than another. But also, we shouldn't kind of like necessarily think about these things, especially in the beginning, whilst we're still exploring this, that it's necessarily that all do the same thing. Depending on the business model that you've got, depending on the customer base that you have, depending on which jurisdiction you're in, you may very well kind of feel like one of them might be more suited than another. So I think in the short term, inevitably, all of these will kind of like fit alongside each other. But I think kind of if you've joined the conversation over the last couple of days, there's a lot of believers, especially when you kind of think about the market infrastructures we need to move these things around. There's a lot of believers in the room around kind of the future of FMIs will be distributed and will be based on blockchain. And if you do, then inevitably you think there'll be a migration over time. What that means for existing systems, what that migration looks like. When do you sunset systems? When do consumers stop using particular transactions? We still live with cash. Are we going to have no cash in 10 years' time? All these kind of questions, I think, will remain. So for the time being, when you introduce them, you have to assume that they will kind of like have to be interoperable or fit alongside each other for a period of time.
No, absolutely. I think that's spot on and a very safe position to take from a regulatory perspective. But at the same time, I think, when we think about digital assets more broadly, and Martin, one of the terms that often comes to fore is atomic settlement. Right?
Is what, sorry?
Atomic settlement, right? So most people tend to think that we need digital currencies and we need blockchain because it brings atomic settlement to fore. Now, from a technology perspective, we do understand that, yes, that's plausible. But what does atomic settlement really mean? And is the industry really ready to embrace that atomic settlement, considering the impact that it has on their liquidity positions more broadly? So what's your view from a technology standpoint? How close are we to real atomic settlement, and what implications do you see from a tech standpoint?
Not super close is the short answer, I think. That's a really good question, because in terms of settlement, different people understand different things. So I've heard it mean settlement means I've got the money in my account at the other end, or I've received a stable coin. Also, it can mean interbank settlement in a central bank currency. Those will vary in terms of if you can send a stable coin, which is a bearer instrument, from somewhere to somewhere else in the world. It's arrived. Does that count as settlement? Mm-hmm. Or do you have to redeem it for it to be settled? In which case there's going to be this whole trail of other bank settlements that are going on. So I think even the notion of settlement really needs to be linked to the business model, because where you've got bearer tokens that are in circulation that are not expected to be redeemed, yep, you may as well think of that as atomic settlement. If you are thinking of a central bank currency settlement between banks, having done a redemption and everyone's settled up and it's finalized, that feels like that's more likely to become a wholesale activity.
Right. Right. And I think, also on that settlement side of things, Sophia, right? So when we touch atomic settlements in particular, we also do realize that, a lot of different people will be building on different chains. While we talk of unified ledgers, and, that's a construct which is obviously being spearheaded in a lot of ways, the reality also lies is that a lot of individual consortia will be built and individual firms would have their own blockchains. And in that construct, when we think about atomic settlement, right, is it really atomic? Or what role does interoperability broadly play there? So if you can shed some light on that, right, with respect to the network of networks sort of a construct.
Sure. And just going back to your original question about sort of the technical benefits, linking to what Bernard was saying, that 24/7 instantaneous settlement, the transparency, removing the risk from the counterparties. These are all the benefits you'd want from atomic settlement. And as you mentioned, Muneeb, on a unified ledger, when you have the assets and cash all on chain, you're able to do that atomic settlement. We're working, over the years with a variety of these projects through next-gen FMIs, existing FMIs, fintech startups, et cetera. And, we're sort of in a place where there will be, some unified ledgers that can do that atomically in like the purest sense. I agree with you, Martin. That term could be pretty overloaded. Yeah. There'll be, as Jan is saying, we need to meet people where they are. So there'll be Web 2 systems, then there'll be different Web 3 approaches, and for a while, those need to coexist together. I do think one big unlock for the Ethereum ecosystem, and it's been referenced yesterday and today, is really the need for privacy. I think there'll be some more content on that tomorrow. So when you're looking at atomic settlement, what's quite exciting now, there's, open source technologies in the Linux Foundation being used in some major industry initiatives in financial services, where you can have mix and match the token types in an atomic settlement. So you can have an issuer-backed token, like a CSD, like a notary style, where it makes sense to have that party behind the token. Completely zero knowledge base token, and there's different exciting technologies for that. And it can atomically settle with just tokenized cash on unmodified EVM, and this is something that's just in the last year is being used by quite a number of these more of network-style projects where you have the tokenized cash and assets, where they were looking for the atomic settlement. So I'd say stay tuned. That's a very active space.
The key question that now emerges based on this conversation is in terms of, who will control the future with respect to digital currencies more broadly. And Jana, a question to you, obviously in your role and in your capacity in terms of working with regulators, working with a lot of commercial banks from an industry body standing point, a lot of fintechs are doing quite a bit of innovation in this space. Some banks have not been able to sort of move at pace with respect to compete with that, as we know traditionally. There are new emerging entrants like stablecoin issuers, etc. So what role do you think banks would be playing in this space? Is there a role for them? And if that is, what does that really mean? What do they need to do differently?
Yeah, well, very, very good question. Disruption most of the time come from the fintech side. There's an inefficiency in the system somewhere. Someone will kind of create a solution, and you need to kind of think about how you embed yourself into the ecosystem. And we would often kind of see those kind of fintechs, those startups, kind of at some point in their kind of journey when they have to scale, when they do reach a point where they kind of want to be kind of have great integration and into financial services, as we talked about before, especially given that you live in a world in which these things will coexist. You see the partnerships evolving. So in the beginning, there might be a little bit of friction. You might see a little bit of resistance from some of the banks, kind of thinking, this is just something that will go away. But I think kind of Paul again yesterday was saying, now's the time to act. Otherwise, all you will be doing is playing catch up. I think every single organisation needs to kind of think about what this means for their business models, for their companies, because the technology and the way that we just kind of talked about it as well is unstoppable. It's here. It's not going to go away. So I don't think you can resist. I think you need to kind of think about the role that you do want to play. But also there are two different things happening here. We've got the new money, the new forms of kind of digital assets emerging, and you want to kind of think about how that kind of is integrated into existing financial services. But then you've got existing financial services, you've got existing money and assets and liabilities that again at the moment is kind of more prevalent. It is that there are bigger markets. They are currently what we use to kind of live and pay and invest and kind of buy. And so those existing financial assets, and I think again it was Peter yesterday that was kind of saying there's a huge opportunity to kind of think about how you take those existing financial instruments and make them fit for purpose for the future. So they will have to at some point in time kind of think about how they make sure that they can also equip their business models, their products, their services to kind of reap some of the benefits that we kind of talked about.
No, great point. And Bernard, that sort of brings me to you for a question. With respect to, obviously, as Jana mentioned, this is an evolution, and it's obviously taking into account what is existing and continuity of those existing services with the emerging new paradigm. And within that construct, if you think about broadly on the digital currency side right now, there is a rise in on-chain FX liquidity pools, et cetera, that's happening as we continue through that paradigm. So what do you think would be the impact on the role of correspondent banking more broadly within that remit, right? So if you think about it purely from a bank's perspective, or even for that matter, if you think about corporates who you work with closely who are transacting cross-border, how does that emergence of new liquidity pools on-chain sort of impact that existing status quo?
I think this is really the kind of big advantage. Having those liquidity pools, having liquidity on-chain, and eventually being able to bypass the correspondent banking network. So basically having a kind of, I call it a peer-to-peer transaction facilitated by a financial service provider custodying my digital assets. So it's really kind of moving money from one party basically to another party without basically running through those networks of correspondent banks, which slow down the process, which increase costs, and of course also increase all the regulatory efforts because every bank has to do a clearance step in between. Now, if we can bring that just to one party, basically doing the custody providers of the payer and the payee, doing the AML, KYC, KYB checks, I think this is a tremendous improvement, and that exactly brings the time savings, the cost savings that we all talk about when we are referring to cross-border payments. So by nature, this basically alters the business of the financial services institution. So they basically need to think which services are they going to offer to stay relevant in the future. And providing a custody service, also as a traditional bank, I think is very, very relevant to stay a meaningful partner for your clients in the future.
And on that point, if we just take into account what Bernard just said, right? So the whole cross-border paradigm and the settlement element of that is sort of changing and evolving. Tokenized assets and on-chain liquidity pools seem to be playing a significant part in that. So Sophia, what is your view, right? So does that tokenized asset paradigm and on-chain liquidity really create a new efficient FX and settlement system? Or is there still a gap within that we need to look at and uncover?
Yeah, well, I think what you asked to sort of start this thread of conversation was pretty interesting. So I do want to go back to it. As we look at tokenized deposits, so commercial bank money versus stable coins and wholesale CBDCs, how are those going to coexist? And Jana was saying, they're going to sort of, it's going to be all of them working together in some forms. I mean, right now, if you look at cross-border, it's basically we're just talking commercial bank money. So now we have, stable coins starting to, find a role there, especially if people aren't banked and in emerging economies. And then the central banks, there's over 100 central banks who are looking at wholesale CBDCs and different stages of maturity there. But I think to your question about, what happens with banks, and Bernard alluded to this as well, so banks are going to look at custody, as Bernard mentioned, custody services. They're also starting to look at, and this came up in the Digital Euro conference last week in Frankfurt, a bank who's issued a stablecoin said, we're looking at our liabilities on our balance sheet, and now there's different forms of money, and instead of sort of losing that, our deposits to consumers who are now using stable coins, we know, there's some risk issues, and, people need to assess the different stable coins and options. They have a relationship with us already. They could use their banking app with us, but by launching a stable coin ourselves, we're looking at the 5-year horizon and saying this helps with funding risks and liquidity risks. So you see sort of that co-opetition, and people are just trying to figure this out as we're going along. So we'll, see interesting dynamics, I think, in the next few years.
Interesting point. And you mentioned a lot of central banks already also looking into this space, right? So which, Jana, brings me to a question to you, right? What is the role of central banks in this space? And if central banks are actively now looking into this paradigm of evolving cross-border payments, what will be the role of commercial banks going forward? And, would commercial bank money still be dominant in cross-border remittances, or would central banks take over?
Yeah. Well, I think it is absolutely incumbent on everyone, as I said, to invest in their own capabilities. You have to look at this evolution and kind of think, what role do I want to play? And when we're asking that in industry, and when we're asking it as commercial banks or as fintechs, the central banks similarly need to ask themselves the same question. So I actually do think the fact that they are actively investigating retail CBDCs, wholesale CBDCs, doing experimentations, investing in their own teams and their capabilities is very positive. It is a good thing because they will still have a role to play in the future. And so kind of they need to kind of know the impact it's going to have on them and be prepared for that. Because otherwise you will kind of have broken change, you'll have broken transactions, things wouldn't be able to kind of flow end to end in places where that efficiency that we just talked about and the benefits that we want to realise kind of sometimes need the technology to kind of flow all the way through. So like banks, I think central banks do need to kind of keep looking at this. But the question then still comes back to it's not a technology question because we can do that bit. Even if we can kind of get across all the kind of regulatory alignments or hurdles or barriers, then that bit is good. But when it comes to, again, the business model and the business case, you need to understand, well, whose balance sheet would all these things sit on? Who's actually kind of carrying that risk? Who has got the relationship with the customer? And so central banks don't want to become commercial banks. It's not their roles. They know that. They don't want to step into that space. But also they're not completely averse to it. When you think about cash transactions and the role that central banks kind of play in those ecosystems at the moment, society would expect them to kind of be able to kind of step into those spaces and places where it makes sense in the future. So again, kind of it's a complicated kind of ecosystem, but I think everyone should, rightly have a look at their capabilities.
Quite interesting. And again, so Martin, if we take that point into consideration for a minute, right? A lot of banks and ecosystems have evolved which are building sort of interbank settlement systems as we speak. And in certain cases, they're being built in their own silos. So is this really meaningful, or do you think it's an incremental change, or is this something which is more tangible and would lead us to something more foolproof? Pertaining to the point that Jana mentioned, right? So it has to be a confluence of regulators, central banks, and commercial banks sort of coming together and understanding what problem are we really solving and to what effect. So where do you see this change happening?
So in terms of the networks that are being built, I see that very much as part of the evolution of the industry, and it's almost in a Darwinian sort of way, in that they're trying out different business models. They're trying out, do they have a business case? Where they're building networks, it's largely because a tokenized deposit has to be KYC'd. It belongs to only customers of this bank, and I think that's kind of fundamental in terms of the difference between stablecoin and tokenized deposit. And I think a lot of what they're doing is trying to scale up tokenized deposits to the point where they've got as close as they can to the reach of a bearer instrument, but without drowning themselves in compliance. I don't think they've kind of figured that out yet. In terms of connecting these different things, again, the tech, the interoperability, it works. There's multiple suppliers with multiple solutions. That's not so much a problem, but having groups of banks that trust each other's KYC, that trust each other's customers, that are willing to settle in the same venue, those kinds of things, that's quite difficult, as well as how is everybody going to economically benefit from all of this, so the business model side of it. So I see it as it's a stepping stone, and I suspect we'll either see some big consolidation, or we'll see just kind of almost like a two-tier system where you've got the stablecoin world, which is global, but possibly only for larger players, and then you've got kind of individual tokenized deposit where it makes sense for the business cases as a whole kind of stratum of different solutions that are out in the industry.
So I think that's quite a big spread, right, if you think about it from that perspective. And Bernard, coming back to your earlier point where you touched on AML more broadly, right? So, and if you think about the regulatory and the institutional barriers that we think are relevant in the digital assets and the digital currency space more broadly, how do you see AML and compliance sort of being impacted by leveraging digital currencies or DLT, particularly with respect to transparency, auditability, traceability? Is it positive, or is it still a blocker in certain cases?
I mean, let's take first the customer stand. Our customers clearly tell us they want to be compliant, irrespective of the legal situation with AML and KYC. Whether this is a bank or whether this is a very traditional enterprise. Even if they are not forced, I mean, theoretically, at least under MiCA, they could go in self-custody, do whatever they wanted to do, because you only have to KYC and AML the stuff once you hit the fiat world. But they clearly say, we want to be on the very safe side, no incompliant transactions. So that puts it back. We need to work with custody providers, enable them to get data points from the enterprise system, things like legal entity identifiers, to do really on a transactional basis the AML KYC checks. I think this is non-negotiable. So we need to be on the blockchain world as safe and as secure and as compliant as in the traditional banking world, which I think can be done. We have all the tooling, as we concluded as a panel. The tech is there. We just need to implement it, we need to play it, and we just need to live in a more modern stack. I think everyone needs to look into that, needs to look into staying compliant, and needs to look how to stitch the stuff together. As I said, the tech is there, but the stitching together, I think, is the challenge, and having kind of ready solutions end-to-end for our clients. I think this is the big challenge.
And Jana, just on that point, right? So if you think about the role of regulators, more often there's a case being made that the regulation is slow and it doesn't follow at pace. And there is also a question in terms whether should we act first and the regulation should sort of enable itself post that, or should we wait for the regulation to give us a very black and white guideline and then do what we need to be doing? So what regulatory changes do you think are needed or pertinent, or what mindset change from a regulatory standpoint is sort of needed to make this more real, to make this more palatable, to make this more production ready at scale?
Well, I think the one thing about this agenda that is really interesting is that you don't have to wait for the regulators to do something. You don't have to wait for the regulators to invest in the technology. I think there's a period that we've kind of lived through post 2008 where there was excessive caution to the point where we kind of think about eliminating all risk from the system. If you take all risk out of the system, then you will have no innovation. You do need to kind of like allow a healthy balance between that kind of like innovation and the way that we think about it and the kind of regulatory relationships and control that we do need to show. But again, kind of regulation, if you think about it in this space as well, again, two buckets. There are regulations that was put in place for what we knew the world looked like. And in the future world, some of those regulations may prohibit us from doing things that it didn't even know was going to exist. So those need to be reviewed and removed to allow people to kind of progress and invest in kind of like the technology where it makes sense for their business models and their customers. And then there's actually kind of like regulations that can be enabling because existing regulations, again, have implemented controls and risk frameworks that may very well look at some of the developments and classify them as unduly risky. And so the adoption is slow and the way that kind of like people think about bringing it into mainstream kind of financial services. So again, regulations, by coming out with clarity, by kind of coming up with regulatory frameworks, can actually help people better understand that risk, which may very well kind of like become more palatable, and then adoption will kind of grow, and banks will be kind of like be more willing to kind of like onboard, use, implement, issue some of these kind of like monies and assets that we talk about. So in many ways, kind of like where we are now with kind of regulations kind of catching up on stablecoin and crypto assets, it is because we feel like that will give people clarity and may very well be a catalyst to kind of like help do it. So it's not always kind of like bad. I think regulation needs to come at the right time, and it needs to kind of like be focused on the right things,
Right.
because ultimately it is also aimed at problem solving, not necessarily restricting.
Absolutely, and it's sort of also giving us a protective layer to make sure that we are very compliant with consumer duty and whatnot, right, alongside that. So completely agree with that point. But broadly, Martin, on some of the key aspects that Jana just mentioned with respect to understanding the risk and the compliance-related issues, and Sophia touched on it slightly. One core construct that we often come across is that debate between if you are doing digital assets and digital currencies, if you're thinking about blockchain, what is the permissibility to do it on a public versus a private blockchain, and what is more viable? Though we strongly believe that the public blockchains have come to a point wherein they're more mainstream, more widely adopted, they're more secure and more compliant in a lot of ways. But when we think about cross-border remittances more generally, so what is your view, right? So where would you place the public versus private debate?
I think there's definitely a place for public blockchains with stable coins that are bearer instruments. I think there's quite a lot of an issue trying to use those with tokenized deposits, particularly around outsourcing regulations and those kind of things, and reconciliation. That's quite hard. But it's kind of like that area that's between the KYC gateways at either end. That's relatively public. I think that works well for public blockchains. I'm not sure how many public blockchains you need or you will have. There's quite a lot at the moment, and that causes some fragmentation. But I think very much there's talking before about how these things may stratify, and it may well go that way as well, where you've got bearer instrument issued stable coins that are outside of the KYC world until they hit their on-off ramps on global public networks, and then you've got more regulated instruments like tokenized deposits on more private networks with a smaller attack. I mean, yes, they are as secure as they are, but more privacy usually means more security, right? People can't see it, they can't attack it. So I think there's room for both, and it probably lines up the same
obviously
way.
it's a bit debatable on that narrative that we might come and say that yes, you can have that privacy now enabled on public blockchains as well. So in fact, we have done quite a bit of work in that space as well. But Sophia, I mean, if we take this question a little forward, and let's say if we look out 5 years from now, what is your view? Do you think correspondent banking will still be the mainstream and the backbone of cross-border remittances, or do you think blockchain and DLT-based networks will rule?
Yeah, well, it's an interesting question. Even if you look backwards 5 years, just crypto as an asset class, ETFs, with crypto, tokenized money market funds. So there's just it's this incumbency and momentum that's built up in the last few years, which is now why you see this excitement and the velocity is really increasing of people doing work in the space. In terms of Kaleido, we're working with over a dozen central banks. A lot of these are, wholesale CBDC, moving into tokenized deposit projects where they're not just looking at account-based, but also bearer token models. So what does that mean for regulators? And, there's different trade-offs. That's even just on permission chains. With public, I was at an event last year with the Atlantic Council, and one of the banks was asked, what would it take for a bank to be on a public chain? And then the person said, we'd need to be able to guarantee we're not transacting with the sanctioned party, who's like a validator and putting transactions in a block on a public blockchain. So those are some interesting questions to consider. And is the bank at fault if they are using a public blockchain? I think last week it came up in Frankfurt in some of the events there, and someone was saying, if you take money from an ATM in a bad neighborhood and then you get mugged, is that like the bank's fault that the ATM was in a sketchy neighborhood? So not an exact analogy, but you can see the wheels are turning. People are trying to figure this out, and I think regulators need to examine that from public chains. Obviously, from a stablecoin perspective, let's say the major stablecoins are, they look at the travel rule, they use tools to be compliant with that. So it's a little different depending who you are in the ecosystem, with your respect to them being able to use public chain right now or not, and then of course working with the regulators in your jurisdiction.
Fantastic. And Bernard, just picking up on that question, and obviously, with your body of work more closely related to the corporate side of the world from a treasury standpoint and banks, so which asset class do you think is sort of, deemed to be fit for purpose, right? So if you think about stable coins, and Sophia mentioned there are quite a few of them available. So which ones do you think, or we don't need to get into names, right? But broadly, more specifically, from a asset classification standpoint, which ones do you think are more deemed fit for purpose? And on that note, from a commercial bank's perspective, would you think that commercial banks are more sort of safer in terms of doing tokenized commercial bank money deposits versus stablecoins?
Well, I think it depends very much on the use case. If you have a payment use case between a buyer and a supplier, then I do believe a well-done stablecoin is the best means of payment. And well-done means it's fiat-backed and it's transparent in the backing, and it's high liquid quality assets, so cash holdings, T-bills, and the like. So this is the class of assets I believe are very well suited for cross-border trade between a buyer and a supplier. Now, the story is of course slightly different if I'm doing intra-company transfers. So from my Asian subsidiaries to Europe, from my American subsidiaries to Latin America and the like. So then I think the story is different. Typically, I can sit with the same bank in multiple countries. Now then, a private permission blockchain with commercial bank money tokens might be the first choice because you work with a trusted party. It's very similar. It's kind of a bankish approach running on a blockchain rail. So you see it as an account, you feel it as an account. It's bank money, and this is where customers get started. So if it's a kind of controlled setup, if you work in an ecosystem where everyone's with the same bank, then I think commercial bank money tokens are ideally suited. If you have a more open payment environment, buyer, supplier, cross borders, I think look for a well-done stablecoin that is fiat-backed and has great audit capabilities.
Perfect. And from a future of commercial bank money and cross-border payments now, and based on the discussion we had, which has been pretty enlightening in a lot of ways. So Jana, what does an optimal cross-border model look like in your view?
That is a big question. I think if we do kind of look forward into the future, we have been talking about, we started the conversation there, we talked about the kind of issues in cross-border payments for so long. there's been kind of like something that kind of like just by its very nature and the way that it's evolved across jurisdictions had these inherent issues that exist. I would look at an ideal kind of cross-border model and in which it is that you have removed some of those inefficiencies, where you actually provide a good customer experience, good customer journeys, where you kind of can support businesses in kind of transacting in the way that they should cross borders more seamlessly by leveraging the kind of like technology. So I think kind of when we do that kind of like, business modeling, you think about the business cases, it kind of brings you back to the customer. And I think it was Sophia that kind of talked about it kind of like earlier. A lot of these kind of products that we develop, a lot of the kind of times when we think about kind of what good looks like, we do it from a technology point of view. We look at it through kind of the lens of the organizations that we work with. We somehow think that kind of like all banks have the kind of like same business models, they're all homogenous. But we do need to look at the outcomes. If we want to kind of know what good looks like, we need to kind of know what that outcome is that we are trying to achieve. And ultimately, it's going to be customers and businesses and the people that we provide the kind of the products to that will decide. If we see adoption, a lot of the questions that you kind of talked about will kind of like realize one way or the other. So we shouldn't lose sight of that. Ultimately, kind of like these developments should benefit society. It should benefit us as users of the things that we want to do with the money that we have. So,
absolutely, I think that's spot on. And let's think about a scenario where every commercial bank issues tokenized deposits for a minute, right? So we know a lot of them are already thinking about it, talking about it, and whatnot. So Martin, in your view, what will be the biggest impact on liquidity and risk?
I think if they're all issuing their own deposits, then there's going to be that will rearrange how the system works in terms of what works with what interoperates with what. I think there's very likely to be a natural network effect there, where the largest banks will end up being the venues where people do the most business and continue to do that. And the fact that you are then in this world where if you've taken out correspondent banking, all the jobs the correspondent bank was doing in that jurisdiction for you around the transaction, the KYC, you need to do that yourself. If you're a global bank, you have a huge advantage because you probably have a presence there anyway. So I think there's kind of winners and losers there, but if you're a large global bank, you're more likely to be a winner because the reach becomes really important. So having reach into all of those countries in-house becomes a huge advantage in the way that it isn't necessarily today.
Yeah. And I would say if you're a large global bank, but you're an early mover as well.
You
right?
might have realized this.
Then makes it more pertinent. Sophia, to this particular point, right? So let's think about this where Martin mentioned you now need a sort of a network scenario for this to manifest. So where does it place the role of technology, right? So do you need a sort of an orchestrator, which is an industry-wide orchestrator coming in and sitting in the middle of all of this and be able to bring it all together? And what role do you think DLT infrastructures could play there?
Sure. Well, our perspective with the platform we offer is very agnostic, and we want to preserve future-proofing and optionality. So I think one thing that was said in the summit is if you're not doing something already, you're too late. And there's multiple future scenarios as you're painting. And there's going to be winners and losers. So I think it's important to, look at what, if you can see there's really two main groups you're mentioning. There's these large networks. It could be a new FMI. It could be an existing FMI who's reinventing themselves in this new world with digital, different forms of private and public forms of money. And then there's banks and asset managers. They want to launch assets to all of the networks. I mean, they're looking for, liquidity. They're looking for distribution. So you really need to think of a tech stack that's flexible enough and not create very limiting tech choices. In the Web3 world, there's a lot of communities, they have the one token and they have the one answer. So it's saying everything's a nail, I'm a hammer, and use my hammer. So I think just, to financial institutions, make sure you're really pursuing a flexible approach that's modular, more plug and play on the tech side, so you're not limiting where you could go, because you look in the last 6 months how much things have changed in some parts of the world with just regulatory and other aspects. So you don't want to be boxed in, and I think if you're a bank, if you're a financial institution, make sure at the application, the smart contract level, you own the IP, you own your destiny, but you're also agile enough to be able to move quickly because there could be multiple scenarios going forward.
Perfect. So I think that sort of brings me towards the last bit of our panel, and we could continue this discussion for and so on. But let's imagine a world where all the commercial bank money is tokenized and all different asset classes are available, and you're now able to settle on chain. What is, and I'll come to you one by one. So what will be, in your mind, one biggest unintended consequence of this? And who do you think would benefit and who would lose because of that consequence? So Bernard, maybe I start with you on that.
All those emerging digital currencies. And I think today it's not clear who will be the winners and who will be the losers. For me, one thing is clear. Winners will be who embark early on and figuring out what is the right solution to your customer problem and strike the right business models. And I think cross-border payments are a kind of sweet spot. So I'm just seeing one question here in the feed, basically asking, does it make sense to use US dollar stablecoins for domestic payments and for flows like GBP to euro to Japanese yen and so on?
Yeah.
So this is an interesting question. And this process basically also relates very well to the question who will be the winners and who will be the losers. For me, the question is, do I use a US dollar stablecoin just as a kind of bridge between geographies that may or may not be reasonable? It depends on how well you manage the ends. So how much do I need to charge the customer for getting from yen into USD or USDC, a US dollar denominated stablecoin, and then back into euro? And only if the commercials make sense, it's a good bridge.
Perfect. And
for me,
no, thank you, Bernard. I think we are almost, top of the hour for us, but maybe a quick 10-second perspective from each of you. Jana, who do you think would be the winner or the loser?
Winners and losers. I'd like to think that most of the time you kind of like in control of your own destiny. You need to make a deliberate decision in terms of kind of like what you want to do in this space. Even if your decision is that you will sunset what you do or that you don't have a future, that you kind of like can play for in this. The one thing that we didn't talk a lot about today is the role of FMIs. We have a lot of existing big FMI systems, and those need to be evolved. I mean, those are the ones that will not be around in the future.
So maybe that's one for our next panel discussion. Martin, your take, some final comments.
So I think in that world where you have that level of ubiquity, we'll start to see some parity between the biggest tech providers, the biggest stablecoin issuers, and the banks. So I think there's a little bit of a blurring there in terms of they're doing adjacent things. They're already starting to creep into each other's territory from both directions.
Great point.
So I think that will be large, but also the more hybrid companies are more likely to cover more
Sophia,
space.
Last words.
Yeah. I'm not an economist, but it's interesting seeing sort of the competition, forms of currency, different roles of money, how when you're removing frictions and now you're moving to digital rails, a lot can change. So
fantastic.
Exciting times.
Thank you so much. We have a few questions coming in, but I think we are already top of the hour. We can take a couple of questions. All right, thank you. So
the whole rough of them.
Fantastic. So we'll try to endeavor to answer some of them offline as well. So maybe we'll take just two. The first one: how can regulatory compliance be ensured across different jurisdictions when implementing blockchain technology? Jana, maybe one for you.
Oh, well, I'll be quick. I mean, that is a difficult one. It requires collaboration and cooperation kind of across jurisdictions. These things need to evolve together. We do see the regulators giving this a go. Kind of a lot of the times they kind of come together to kind of like explore and the experimentation. I mean, the technology in and of itself should help us with regulatory compliance and kind of regulatory reporting, but I mean, it is going to be hard across jurisdictions to kind of homogenize these things.
Fair enough. And maybe the last question that we take in, Martin, I'll pass to you. Security risks, right? Particularly the cyber attacks and fraud in cross-border blockchains. Quick view on
almost exactly the same answer, that a lot of cooperation is going to be needed between different jurisdictions because it's such a global network. You can have threat actors in all sorts of different places. So that again, coordination between the both the banks, but also security and law enforcement across those different countries is really important and has been.
Fabulous. Thank you so much. We could have gone on longer on this panel, but sadly we'll have to end it here. So thank you so much for joining us. And Claire, I hand it back to you.
Thank you. Oh my goodness, what an amazing panel that was. I mean, really, thank you so much, Sophie and Martin and Jana and Muneeb and also Bernard. It was good to see you on virtually today, Bernard. But thank you so much for making the time. It was a really great way to round out the day, and that's really is rounding out the day, guys. I hope that you've found a lot of interesting tidbits today. We've jumped around and we covered everything from supply chain through security. We've talked about public funds management and making it really real. This is really happening, and I think the benefits are all there. And I think to spend a little bit of time at the back end of the afternoon, like thinking about really how to make this concrete and some of the real issues that need to be resolved for us to start to continue the ball rolling and continue the progress. I just want to just remind you, tomorrow, day three is all going to be about zero knowledge proofs. And I think that if that's your jive, then you do not want to miss it tomorrow. Duncan is going to be covering it at great detail, and he's got some fantastic speakers lined up for you. So we really do hope that you come back tomorrow, 1:00 Central European time. And I will also say that I do believe at the end of today that you're going to be able to pick up your day 2 NFT. I know that some of you collected it yesterday. I think your day 2 NFT will be available for you at the end of the session. It's right there. Don't be shy. Take it away. It's our gift to you. And we're incredibly thankful for you to join us today. As per usual, these videos will be available for you later if you feel you need to go back and review them again. There were many people yesterday that were asking me about just that. And so, yes, you can do that. So do join us tomorrow. Have a really fantastic rest of your day, evening, wherever you are in the world. And we look forward to seeing you tomorrow. Thank you.